Afternoon and welcome, ladies and gentlemen, to my little amateur property observer annual roundup of the Thai property market. Really, my observations about what happened last year and some guesses as to what will happen in 2022. Now, a brief introduction for those who don't know me. My name's James Pitchon. I spent nearly 33 years working with CBRE in property in Asia, last 29 years in Bangkok. I retired 2 years ago, and Greg Watkins decided I was being far too lazy and asked me to become an honorary advisor to the British Chamber and to chair the Property and Infrastructure Group. And one of the things that what we do is try and host about every 6 weeks a webinar and hopefully in the future live events covering a specific area of the property market. So much of what I'm going to say today is a complete plagiarism of some of the other excellent speakers we had last year from JLL, CBRE, Savills, Knight Frank and Horwath. So a lot of this isn't my own work. It's just a summary of what other experts have been saying. So another year of COVID, just when we thought we were coming out of it in 2021. And so what's happened? Well, I'll start off with the residential market. It's been slower. So single detached houses completions were down about 20% and transfers were down about 20%. Townhouses, new supply down about 13%, transfers down 10%. But condos has been a big drop. So there are only about just over 26,000 completions in the first 3 quarters of 2021 compared to 60,000 for the whole of 2020. And transfers were down about 45%. Now, in the housing market, low-rise housing is driven, as always in Thailand, by end users, not speculators or investors. But still, demand has been challenged. For some people, but especially anyone who's been employed in the hospitality sector and many in the retail sector, they've got lower incomes. Mortgages are harder to come by, but banks have been tougher on their qualification for mortgages, and there's already high levels of personal debt. And the lowest end of the market are generally the people with the most debt, and they've been the worst affected. But the housing market has continued, and some developers like Supply and AP have had very good years on housing. They've been able to shift from their primary product, maybe being condominiums, to far more concentration on the low-rise, non-speculator driven housing market. And they haven't suffered big drops in revenue, but it's been a real mixed picture between developers. And it's tended to be the bigger guys that have been more successful and the smaller developers that have been squeezed. Now, condominiums has been a big drop in new launches, as I said previously. And in Q2 and Q3 of last year, there were no CBD launches, and that's been a long time since we've seen that. Most of the new launches were at the cheaper end of the market, I would say mid-level market, mainly by large public listed developers. So the market's not dead. People are still buying. So it's not a repetition of the 1997 financial crisis where the market just came to a grinding halt. So there's still life in the market, but it's a lot slower and it's a lot tougher and there's a lot of challenges. So for the condo market, for example, there were about 32,800 developer built completion transfers and 16,000 second-hand sales. So it's still an illiquid market. You know, that's 16,000 resales in a market where there's about 1 million built condominium units in the whole of Bangkok. So that's only about just over 1% of the total stock that is transferred or resold in a year. And I think you see a lot more units being offered for resale than are sold. So it's a strange market on condominiums. It's easy to buy and hard to resell. Going forward, the concentration has been last year very much on developers selling clearing built but unsold inventory. And this has been for the condominium market. And I think this has been the biggest issue. In terms of how many unsold units are there, numbers are very hard to come by. But each year, most public companies put in a section 56/2 form to the Stock Exchange of Thailand, where they actually run through the sales project by project. And at the end of last year, we're still waiting for the units for this year. Those public listed developers announced that they had just over 36,000 built but unsold condominiums, and another 25,000 under construction but unsold. That's a total around 60,000 unsold units, a mixture between built units, completed units, and unsold units. If we add in unlisted developers and those listed developers who don't report, well, the numbers could be as high as about 100,000 units of condominiums under construction or built that are yet to be sold. That's roughly 2 years supply at the peak supply figures of 2019. And in addition, obviously, we have what I would call shadow inventory, which are resale units. But as we know, the reselling is still tough. Thais prefer to buy new rather than second-hand. And we're still waiting to see if that will change. The resale market did slow down. I think there were 30% less transfers in the first 3 quarters of last year. Now, really, at the beginning of, or midway through 2020, some people were saying, oh, there's going to be huge discounts, fire sales left, right, and centre. Well, that hasn't happened. There have been some developers wanting to clear inventory and built and completed buildings who have discounted, but maybe their original prices were too high anyway. And there's only been a few resale discounts, mainly from, I would say, mainly foreign buyers, foreign owners who need to get out for various reasons. I used to call them the 3 Ds, which were debt, divorce, and death, as the situation that would create a need to sell quickly and therefore be willing to discount. But the bargain deals have been few and far between in the Bangkok condominium market. So what do I think is going to happen in 2022 in the residential market? There's still going to be demand for low-rise housing, but there's a lot of challenges. Cost inflation is going to be a big one. We're seeing oil prices go over $100 a barrel now, and that's going to affect steel prices. It's going to affect cement prices. I think steel prices have already risen something like 30%. And as the higher oil prices kick in, that can only feed through to higher concrete prices very quickly. So it's got to cost developers more to build. At the same time, banks are going to be reasonably wary about who they lend to, so access to mortgage finance is going to be tough. And we're living in a world where interest rates are quite likely to rise, so it's going to cost the consumer more to borrow money. We already have very high levels of personal debt, which is always going to be a challenge. So I think the domination of big developers is going to continue, and there'll be consolidation in that low-rise housing market, and the big developers will take a large chunk of the market. For condominiums, there seems to be developers are eternally optimistic, and a number of developers have dusted off their plans that have been mothballed for the last couple of years. As we hope we're exiting from the worst part of COVID, or take a more relaxed attitude to COVID with no shutdowns or lockdowns. So we'll probably see more launches. The big question is going to be how these will sell. It's going to cost developers more to build them, so the price is going to be higher. And will people have an appetite to pay those high prices? And I think that's the story to watch this year, particularly in the CBD, where there's been no launches, I said, in Q2 and Q3 of last year. So developers have dusted off their plans. Is there still sufficient demand out there for new product? Will buyers be willing to pay the higher prices? We will see. In the rental market, well, there's less expatriates in Thailand. I've got some numbers for that. There were, in Q3 2021, there were 77,700 people with work permits in Bangkok, compared to 92,000 in 2019. So it's been a significant drop, but not as bad as the provinces, where in 2019 there were 137,000 work permit holders and only 60,000 in Q3 of 2021. Largely, I think, due to retrenchment in the hospitality business, where a lot of the expatriates working in hotels no longer have a job. Moving on, so rentals are edged down, they haven't collapsed. Some have in condominiums where people have been saying, oh, okay, I will drop the rent to get a tenant, but it's a much smaller market. And so the rental yields have been compressed. Rental yields are always, everyone talks about gross yield, which is before any expenses. And people were talking about 8% yields, which I thought was a very optimistic number to be able to achieve. And if you really take out all your operational costs, your management fees, your broker's fee, cost of replacing furniture, the period that the condominium is empty between lettings, I think people would be lucky to get 2 or 3% net yield in your pocket. And that's before you should pay tax. Many people opt not to pay tax, but if you took a net of tax yield, that would be, I think, even lower. Anyway, moving on to offices. We've got a big market, total supply of 9.4 million square meters. When I first arrived in Thailand working in 1990, I think the total Bangkok office stock was only just over 1 million square meters. So there's been a huge amount of space built over the last 30 years. There's another 1 million square meters under construction due for completion by 2024. Occupancy rates have fallen. They're currently at 88%. And last year there was negative take-up. So that means there was less space occupied at the end of the year than there was at the beginning of the year. Now, 70% of buildings are more than 20 years old in Bangkok. So I think there is for the new buildings coming on, there is an incentive for tenants to upgrade their premises. Everyone's heard about the war for talent, and part of one of the strategies to succeed in the war and to attract and retain the best talent is, when we return to the workplace, to have an attractive workplace. Not only an attractive workplace, but a healthy workplace. The BCCT just held a well-attended seminar last week on the air quality in buildings in Bangkok. And only the best quality good buildings have a reasonable air quality, providing their management operates the systems properly. So things to look for: buildings that have LEED certification and wellness certification. These are two global property industry standards for assessing buildings. I think those were the buildings that will most appeal to a certain sector of tenants who want good quality premises in order to attract staff. In terms of future work, the consensus seems to be that we will continue with a hybrid model, that we found from everybody being in the office, that to complete lockdown and nobody being in the office, the hybrid model where you work from home some days a week does work for some people in some positions. And I think companies will continue to adopt that. And what does that mean? That means probably that companies will need less space. Because if you're operating hybrid working, you're not going to have a desk for every person. So you will adopt, in addition to hybrid working, something called agile working. It used to be called hot desking, but we like to keep changing terms in the property industry to make them sound more sexy. So I think agile working is the new buzzword. And that means you don't have a fixed desk. So companies may need less space. So what's the outlook for these new buildings? And it really depends on what rentals companies are willing to pay. So I think there's definitely an appetite to upgrade, as many of the grade A buildings are now 20 years old and would not be considered grade A now around the world. Whereas many of the new buildings under construction really are world class and have LEED and wellness certification. But I think it's going to be challenging for a company to go to their regional financial controller or global financial controller and say, can I have some more money for my office space. So the winning argument is to say I can move to a better building. I'll take 20% less space because I'm going to adopt agile working in addition to hybrid working. So my total rent will not go up, but in terms of the quantum, but I can pay a slightly higher per square meter rent. So we'll see how that pans out. Because some of the developers of these new buildings have quite high aspirations of rent. And when they originally did their feasibility studies, they had a nice graph with rents going up at 5% per year. And that's not happening at the moment. Rents are flat to falling. And as the new supply comes on, the downward pressure on rentals will, I think, increase. But it's not going to hit every building in the same way. I think the older buildings that are, some of them are just about obsolete now in terms of their air conditioning systems and air quality. They will be, maybe they're going to be obsolete. Maybe the people will not want to go to them and they will be hardest hit. And the only thing they can do, if they're not willing to significantly upgrade the quality of the building, which is not always practical or possible, that they will have to drop their rents. And for the new buildings, we'll have to see what rentals they will actually achieve in order to persuade companies to move from one existing grade A building to the other grade A building. Now, this rental drop or downward rental pressure is not going to happen overnight. It's been slowly happening throughout 2021, where rents are flat and a little bit falling. And as the new supply comes on, I think it's going to take landlords of new buildings, it'll take them at least a year from building completion. If they haven't filled it up then, maybe a year before they say, okay, maybe the only strategy is to lower my aspirations on rental. So I think the real pressure on rents will come as the bulk of the supplies come on as being completed per year. And that will be towards the end of 2022 and really 2023 will be the crunch time, when a lot of the new supply currently under construction will be completed. So we'll have to see how that pans out, but I think there's staff are certainly going to want to work in a healthier workplace. And if you want to get good staff and retain staff, you're going to have to take action on the quality of the building that you're on, not just in terms of air quality, but also in terms of amenities. The days of just having a Starbucks or another coffee downstairs being sufficient to give people a feel-good feeling is not sufficient nowadays. So I'll quickly move on to retail, which I know not much about. I'm a bloke. I'm allergic to shopping. I try and avoid shopping centres. So I listen to my retail consultant, who I'm married to. But it's still a very complicated area, because we've got the move to, we got online shopping, e-commerce, the move to omni-channel, where there's physical stores, bricks, as well as clicks with online. Now, the total supply in Bangkok at the moment is about 8 million square meters. And if we have a quick breakdown of the Bangkok stock, this is modern retail, excluding shop houses, CPN, Central Patna, they say in their latest presentation from Q3 last year that they think they got a 20% market share of modern retail, with the Mall Group behind them at 5%, and Siam Piwat operators of Siam Paragon and Icon Siam with a 3% market share. So just looking at Central is a pretty good indicator, pretty good benchmark for the whole market. And they had an occupancy rate countrywide for the whole of Thailand of 91%, so down from their peak. People have suffered, and revenue down 11.4% year on year in the third quarter due to some temporary rental discounts during lockdowns. So there's only so long that a tenant can pay rent when they're not paying any income. The big challenge is we've got about 650,000 square meters of new retail space coming on in buildings like M Sphere, Dusit Central Park, Bangkok Mall, One Bangkok, Terminal 21, Rama 3. So these buildings have got to find tenants, and the existing shopping centres have got to retain tenants at the same time as they're dealing with the transformation of the retail revolution towards e-commerce. But there is still a place around the world for physical retail. People do like to go shopping, and a lot of shopping is not just buying product, but also entertainment, eating out, restaurants. And so we're going to see probably a much higher food and beverage component in shopping malls, or anything that can provide an experience, whatever an experience may be. It's going to get complicated because retail tenants are saying, we want to move from paying a flat monthly rental towards revenue sharing, that we will pay a percentage of our gross revenue to you as our rent. So the landlords are now having to take a share of the tenant's business risk. The complicated bit on this, in the omni-channel retail world that we now live in, is how a landlord can see where those retail sales came from, because the retailer might say, oh, that was an online sale, not from your shopping centre, so I'm not going to pay you the rent for that. So very complicated in this new world. So shopping centres are actually going to have almost, I think, digital twins. They're trying to direct inquiries online to their website and then feed them through to retailers as a way of being able to see where those online retail sales came from, so that they can charge rent on a percentage of the revenue earned on them. So a very complicated world, retail, very dynamic, constantly changing, and very hard to predict what's going to happen. So I'd say watch the big guys, certainly CPN, they've been in the business a long time. Watch their numbers, they're a public listed company, and you can see how they perform. But it's going to be a tough market. And I think the barriers to entry are getting higher and higher. But last year, one of the big news was CPN taking over Siam Future, the operator of Mega Bangna. Mega Bangna was the king of the East in terms of retail. It was the most successful retail centre in East Bangkok. And Central both took out the competition by buying them. So it's going to be the big guys that survive. In the SME retail, I think it's been really badly hit, particularly anything to do with F&B or entertainment. You can walk down Sukhumvit Road now and see empty shop houses. And anyone who's been to Koh Samui will see the desolation of the retail market there, with Chuang Beach looking like a ghost town. And I was up in Chiang Mai recently, and the centre, the old city there, again, I think probably 1 in 4 retail businesses, particularly those aimed at the tourist market, has not survived. They've closed. So the SME retail has been really, really badly hit. Now, the driving force of the Thai economy has still been manufacturing. So I look very carefully at the industrial property market sector to see where we're going. The Thai economy has been driven to a large extent historically by foreign direct investment in manufacturing in Thailand. But last year, the 2 big players in industrial estates, that's selling industrial land for people to build factories, are Amata and WHA. Amata sold 88 rai last year, transferred, and WHA 248 rai, so way down from their historic levels. Now, we were anticipating relocation of manufacturers from China due to both rising costs in China, rising labor costs, and US tariffs. But lockdown has prevented potential investors in manufacturing facilities from coming to Thailand, particularly China, where it's draconian on trying to get back. It's 3 weeks quarantine. They really don't want you to leave the country at the moment with their zero COVID policy. So far, we haven't seen a huge amount of relocation from China, but there is a possibility of pent-up demand. So there's another 2 companies to carefully watch for both the health of the industrial property market and the overall health of the Thai economy. The one winner globally in the pandemic has been modern logistics. We used to call them warehouses, but now we call them modern logistics. So in Thailand, it's about 4 million square meters of developer-built modern logistics facilities, which are around 85% occupied, according to consultants. The trend is very much, it's a growth trend. So e-commerce is a big user of modern logistics facilities, as people want instant gratification, the shortest delivery time possible, and that's only possible through sophisticated warehouses. And there has been growth in demand from the e-commerce sector that's been driving the logistics market. But in addition, the shortage of materials and raw components has persuaded some companies to go from just-in-time manufacturing when you would only get the component delivered just as you were going to put it into your product, to actually stockpiling a reserve of components. And we see that globally with computer chips that go into everything from computers to cars. I mean, some Toyota's just had to shut down their production because they've had a cyber attack on one of their major suppliers, and they don't have reserve supplies in store. So some manufacturers are going from very lean manufacturing to actually stockpiling. So going forward, we have to wait and see, will there be a resurgence in investment in manufacturing in Thailand, driving industrial land sales with people, the migration of manufacturing from China? And will we see continued growth in logistics? I think we will see continued growth in logistics. I think it's still wait and see on the outlook for the land, the industrial property market, where people buy land and build their own factories. The hotel market has obviously been the worst hit market in Thailand out of all the property sectors, and it still looks pretty grim. And we've got test and go on, test and go off, test and go is back. We haven't got the Chinese market because they seem to have no intention of letting their people out, as you can see by their attitude to what's happening in Hong Kong. We have to do 3 weeks quarantine on return. The Chinese were 30% of the market. So are they going to come back? Don't know. I mean, there's a party congress, but some people say that it won't. There won't be anything happening until after the Chinese National Congress, which is in November 2022. So it's anyone still without 30% of the market, it's going to be tough. And now with the Russian invasion of Ukraine and the depreciation of the ruble, that may take out another market that was just coming back in the nascent stages of recovery. Now, roughly, we've got nearly 80,000 hotel rooms in central Bangkok. And amazingly, there's still another 10,000 rooms under construction and due for completion over the next few years. And still more are being planned. It seems to be absolutely never ending. So how these people, how the feasibility of these new projects will look when they hit the reality of the market, I don't know. But there's certainly going to be an increase in supply. So about another 10,000 new rooms. And ground is still being broken on new properties. Now, again, several years ago, journalists were saying, oh, there's going to be a fire sale of hotels left, right, and centre, and somebody was producing a list of the hotels that were for sale. In 2020, there were very few hotel sales. JLL, who are the leading hotel broker in Thailand, say there's been 23 hotels sold in 2021, with about 3,000 keys for a total of 13.2 billion baht. But the average price of these hotels was only 500 million baht. So mainly the smaller scale properties, and more properties sold in Samui, which is maybe the hardest hit resort market. And still not many fire sales happening according to JLL. So not huge discounts in pricing. There's still a big gap between the potential bidders and what people will be willing to sell for. And the banks have been generally very forbearing on the debt owned by hotels. They've just rolled it over. So the question is, will the banks get tougher this year and say we want our money back? Plus, for a hotel, you need working capital. You can't just shut a hotel and do nothing. You've got to turn over the air conditioning. Otherwise, the whole place is going to go mouldy and will not attract guests at all when they reopen. So it's going to be interesting to see what will happen this year. I mean, last year there were predictions about a return in the market, and obviously that didn't happen. And so any guess as to future arrivals is pure guesswork at the moment. You could have a monkey in a dartboard and maybe be more accurate, as we simply don't know what's going to happen. What will happen in Russia? When will China reopen? What's Thailand's attitude going to be as cases arise? Hopefully test and go can at least stay, or maybe like Britain, we give up on it, because the Maldives has not had a very stringent regime on allowing visitors in, and their occupancy levels are nearly back to where they were in 2019. So I'm aware I'm nearly running out of time. So a quick wrap up. What do I think is going to happen in 2022 in residential? So houses, It's going to cost more to build a house. Prices are therefore going to increase for new product, but the buyer is challenged by lower buying power and access to mortgage and higher interest rates. Developers of condominiums are going to focus still very much on clearing condominium stock, and some developers may finally bite the bullet and say, okay, we've got to cut prices to get rid of our unsold inventory. So watch that space. But there will still be new projects launched, mainly in the what I would call more the cheap and cheerful sector, catering to the Thai market. But there are plans being dusted off the CBD market, and we will see if buyers are willing to pay the prices that developers hope for. For offices, companies are probably going to shrink the amount of space that they need, so there's going to be continued downward pressure on rents. There is demand for quality from certain companies who want to have to persuade their staff that they have a great workplace. And in the future, there's going to be more carbon reporting. So developer companies, particularly multinationals, are going to want to be in buildings with LEED certification that they can say, so they can add that to their reporting. And way up in the future, we're looking at net zero on carbon, and how we're going to do that to prove that building is net zero on carbon is going to take a big change in the construction industry. But I think that's several years out. That's not something that's going to happen in 2022. And in terms of rents for Bangkok offices, I think they'll be flat to falling, but the big downward pressure on rents will occur towards the end of 2022 and coming into 2023, when the majority of the new supply is completed. Retail is going to depend on spending power. Are people willing to spend, willing to go back to the mall? We'll see what happens there, but there is more supply. Will all these buildings fill up? And how will that affect, how will they cannibalize existing shopping centers? So extremely competitive in the bricks market, and very competitive in the clicks market, with developers, with retailers having to be omni-channel. There's going to be a big barrier to any new entrant wanting to be a property developer. So it's going to be the developer and landlord market is really a market for the big boys, with the ability to have their own almost virtual world shopping centers as well as physical shopping centers. In the industrial sector, I think it's going to be steady and continued demand for logistics. And that is, I don't think there's much risk of oversupply, because I think Marcus at Knight Frank said most developers are only accepting pre-letting or build to suit. So they're not building speculative supply. So there is less risk of oversupply by speculative building. But the challenge is most people want to be in the same place on Bang Na, and there's very limited land on Bang Na at a price where it makes sense to build logistics facilities. So there's people going to have to decide how to, maybe Bang Na is not the only place you can put logistics, but at the moment everybody wants to be there. Hotels, it's hard to see a rapid recovery. I'm happy to be contradicted on that, but until I see a return of the Chinese market, which I said made up 30% of arrivals, and now the challenges with the Russian market, I think it's going to be a long, slow haul. And against that, we have the background of increasing new supply still coming online. So we're in a recovery mode. The market's coming back, but many sectors are still in a state of growing oversupply in some cases. So it's going to be a challenging market for developers, but with opportunities, particularly for office tenants. And I think in the residential market, there may be some opportunities to buy at discounted prices, but still few and far between. So I'll wrap up there. I've slightly overrun my allocated time, and I'm happy to take questions. So I think the first question was William Queck, an insight into the residential sector. I think I've probably already done that, William. So I hope that's answered that one. Alex Blenko has heard of rumours of foreigners being able to buy freehold land. Well, I'm not close enough to the legal world to accurately comment on that, but I would say highly unlikely. I mean, for many years there's been a a little bit of law that says that a foreigner invested so much money could buy 1 rai of land. I've never met anyone who's been able to take that up. So I still think that will foreigners be able to buy land here for residential? Unlikely. Foreigners can buy land on industrial estates to build their own factories, and they can buy land outside industrial estates to build manufacturing facilities with BOI approval. But I think unlikely. Maybe I'm going to be wrong, but I doubtful. And I would recommend that people read Simon Landy's book on the British Embassy's attempts to buy land 120 years ago, to give you some background on Thai reluctance to allow foreigners to buy land. John Pollard has said, what % was the Russian market in hotel? Right, I didn't write that down, John, so I'm going to have to look that up. But last year's numbers are obviously going to be. Let me just see if I can find some hotel stats in the CBRE report that will be able to answer that question for you. So let's have a look. So I'll go back to 2019 numbers, and Russian arrivals were, bear with me while I look that. Okay, so 2019. There were 2019. There were 1.5 million Russian arrivals, and that was the total market. Was, I think, over 30 million from memory at the peak. Sorry, no, the total market 2019 was 40 million. So Russians were 1.4 million. But there were big spenders in Phuket. It wasn't the just budget tours from Nova shithole in Siberia going to Pattaya. There were a lot of wealthy Russians spending long periods of time, and even in Pattaya they were long stay, dodging that Siberian winter. So it's going to be another significant impact on top of the loss of the Chinese market. Okay, right. Any more questions? Please bash them away, and I'll try and answer them to the best of my ability. Okay, I seem to have either answered everybody's questions or stunned them into absolute boredom. So I'll give just another couple of minutes to do that. So while I'm waiting to see, we got one more coming in. Okay, where do you see condominium prices in 2 years' time? From Mikkel Lars Olderson. Well, let's break it down into two products. I think new product is going to cost more because construction costs are going up. And second-hand, it's very hard to say. Each building has its own market dynamics. So some buildings, prices have barely moved in about 25 years. Other buildings have easily doubled in price. So each condominium has its own set of dynamics in terms of its attractiveness. And so it's very hard to say, and it depends on each individual building. So some markets are not going to move. There's going to be limited demand for them. Other buildings are far more popular, and there's a relatively high liquidity for those units. But I would say this year, apart from maybe a few most sought after buildings, pricing's still going to be relatively flat, and there's still quite a gap between the bid-offer spread. In 2 years' time, I'm not clever enough to predict. But again, I think it's going to be a continuation of the same theme with a huge range of pricing. And some condominium buildings will become almost obsolete because they weren't very well built in the boom years of 98 to 1990 and have been very poorly maintained. So they're becoming increasingly unattractive. So I think some condominium buildings will almost be unsellable, while other buildings are sought after. So you can't say there's a market going up or down. There's going to be no precise index because of the huge variation between buildings. And will we ever see people have a group sale and sell their building for redevelopment? Well, in Thailand, currently the law says that you need 100% agreement from all the condominium owners to sell. And as you can never get agreement in the condominium on just about anything, including what colour to pay the front door, I think unless the law changes, we won't see any collective sales of 30-year-old condominium buildings for redevelopment. So I hope that answers your question to some extent, Mikhail. Right, I've got another question coming in from Lynn. Sansiri targeting the lower end condominium market with 18 or so no projects this year. How should they be more successful? I don't know, actually. I mean, Sansiri are a very well-established developer. They've got a large portfolio and they are close to their market, and they're quite a dynamic company and react to market forces. I'm not sure how they can help with mortgages, certainly on pre-approval. They were talking about building properties first and then selling them rather than going for the pre-sale method. So that should, that will reduce the risk of people defaulting, but it's quite a big risk to build the whole building and then hope somebody's going to buy it. So it's a different strategy. And I'll have to see really next year on how they do. But Sansiri are very knowledgeable about their market, and they have had a historic track record of success. Whether their latest policy will succeed, I'm not clever enough to be able to foretell the future, Lynn, on that one. Now, William's got another question. We can see new luxury or branded landed residential projects in the pipeline of developers. What do you think this is the affordable price in the current market situation? Well, William, difficult one to answer. Not every branded condominium project has been successful, right? Some have. St. Regis was successful. The Sukhothai Residences was successful, although it's not going to be managed by Sukhothai anymore. And there have been the Four Seasons on the Riverside has been successful. I think Mandarin has been successful on the Riverside, but not everyone's been a winner. I won't talk about who hasn't been a winner. And there are still projects under construction where people are willing to pay premium prices for a branded product where they get a hotel style of service. I don't think it's possible to say, put a price per square meter on that. Because some of these projects will be leasehold and some of them will be freehold. But some people have been willing to pay very high prices for leasehold if it's got the right location, right product, right hotel management company. So there isn't one number you can pick out the air and say, this is the perfect number, and if you put it at this price, you'll sell. So much, I think, depends on the product and people believing in the product, because so much is to do with the brand and the confidence and the level of service that will be provided, and confidence that by having this hotel management company, there'll be a certain level of quality assurance on the construction quality of the building. So not possible to answer your question, but certainly the 0.1% of people in Thailand, Thai buyers, the rich have got richer in the COVID crisis, many of them, and they still have money to spend. So they're still buying Ferraris and they're still going to buy the most expensive condominiums in Bangkok if they believe it is the best product in the market at that time. So I hope that gives some answer to your question, William, but not a perfect answer. Right, any more questions? Just waiting a bit. So I just go on a little bit to talk about the BCCT Property and Infrastructure Group. So our objective is to keep BCT members informed, both from a corporate point of view or a personal point of view about the Thai property market. And we will try to hold a series like we did last year of ongoing, some of the webinars, maybe hopefully some live events this year, covering each sector of the market and inviting property experts to talk about the market and really on from a statistical point of view, not just trying to talk up their own book or to sell that particular product. Now, Mikhail's asked me another question. What segment is best for investment on a 5-year horizon from current levels? Low or mid to high end segments? I presume, Mikhail, you're talking about residential. And I guess there's 2 questions to answer there. Which has got the best chance of capital growth and which has got the best chance of getting a reasonable rental yield? I would say that it's hard to answer that, but there's still going to be a rental market in the Sukhumvit area between Asok and Tonglor, and that's still going to be the most popular expatriate residential area. But expatriate housing allowances are flat to falling, and so you need to have a detailed understanding of what people's housing allowances are, and to see, because they can't spend any more. People will spend all the company money, but they won't spend any of their own money. And many people today are not on the old expatriate package and they're paying out of their own pockets, very more cost conscious, but they still want to live in that. I think 80% of rentals take place in that Sukhumvit area that I've just mentioned. So you need to fully understand what people can pay and what they want for that money, whether they want a 2-bedroom or a 3-bedroom. So I would say that look at the buildings, look at condominium buildings that are well maintained and continue to attract tenants, and they will give you the best rental performance, but yields are likely to be low compared to cost. I think you'll be struggling to make 3% net and less than that if you pay tax. As to capital growth, very hard to say. I think at some stage, some of the properties, it'll be the best of the best becomes sought after, particularly by Thai buyers. But how to prove what is the best of the best is hard at the moment. I mean, a couple of projects that, within what I can see from central Bangkok, things like Athene Residence and Park Chidlom and the Sukhothai Residence are still very sought after properties where there is a continued demand from Thai buyers to be in those properties. But that's not an exhaustive list. There are more, and if you go down to smaller units or less expensive units, my market knowledge is no longer sufficient enough. But I think you have to have a detailed understanding of the liquidity in the market and the ability of tenants to pay rent to be able to choose. And there's no secret formula to be able to do that. John Rounds, which area in Bangkok is the best area to bar or restaurant? I don't think there's any great area at the moment in terms of bars. I mean, the main tourist trade is still along the Sukhumvit spine, but I would be cautious about buying a bar or a restaurant at the moment, given weak tourist arrivals. There's so many bars and restaurants that have gone out of business. But I'm not certainly not a retail, and the only experience I have of bars is drinking them as a part to owning and operating them. Now, Con Kiwali has asked, how is the trend of the Bangkok office market after the COVID-19 pandemic? I think I answered some of that already with companies probably needing less space, a move to hybrid work where people work from home part of the week and go to the office the rest of the week. The office is not dead. It's still going to be around, but work patterns will change and companies will move to agile working without allocated desks. There will be landlords that will operate serviced offices, so rather than letting WeWork operate the office, they will operate themselves, giving flex space to companies and a breeding ground for small companies. So the big question is for the office market is what rents will people pay for the new buildings? There is a desire to upgrade because the old buildings, the old grade A buildings are 20 years old, but how much rent will people pay to move to a new and better quality building? Right. anyone else? We're sort of approaching time up before Greg's going to cut me off. I think we've got a 5 o'clock cut off to allow you to go home, or if you're at home, some of you are at home already, at least to start work. So any other questions? So I said for the BCCT Property and Infrastructure Group, we hope to have a series of events this year covering each topic of the market with a market expert covering it in more detail. And we will post those events as they come up. Some of them will be webinars allowing people to attend. The more data-driven presentations, I think we will do online, but we would hope to have some panel discussions in live events, similar to the discussion we had on air quality in buildings last week. So I think that's the wrap up from me today. I don't see any more questions coming in. So once again, on behalf of the Property and Infrastructure Group of the BCCT, I thank you for attending, and I hope that was useful and informative. And despite the fact I'm now strictly amateur, that it did give you a reasonable picture of the market. And we'll see how many of my predictions come true. I tend to forget what I said instantly the moment I get off this call. So I rely on you to hold me to account for anything that I got completely wrong.
Many thanks, James. Fantastic as always.
Okay, so I hope everyone has enjoys the rest of the day and have a safe week, and good luck with 2022. So I'll see you. Bye-bye.